Okay, folks, welcome to Thursday Night Stock Charts Live. I apologize if you have to catch us on the replay because the some of the emails that went out at the wrong time. It still shows 6 o'clock and not 5 o'clock. My apologies in advance, um, but I needed to go live early today because I have a conflict, and I thought it too important of a day in the markets to simply not have the live stream. So before we begin, I wanted to give a shout out to our sponsor over at TrendSpider Automated Technical Analysis, 35% discount code. I believe link below. If it's not linked there right now, link there by end of live stream. What the So let me make sure it's on there. So what we're going to talk about tonight is what happened today. And I think it's fair to say that we've been talking about sector rotation, dangers in the market vis-a-vis too few stocks driving the overall market higher. It's unsustainable. And of late, when you have the triple Qs and the S&P 500 sporting as we closed last night with an RSI above 80, bad things are going to happen. So sure enough, it's exactly what happened. So going into the new trading day today, what we did is we added the shorts yesterday. We'll go over the reasons why in a moment. We added the shorts of the triple Qs. They closed down over 2% today. And we built a pretty quickly a large position in the Russell 2000 futures beginning on Tuesday with only a one lot. And then I started doubling up on the positions, and we went into the day with a fairly significant position on the Russell 2000. So you had the Qs that dropped down by over and closed down by over 2%. And you had the Russell 2000 closing up by roughly 3.33%, something like that. So a very powerful move in the equity markets. The question is where to from here? What is out there that is concerning, not just for the Qs, but for the entire market in general? What does the weekly chart look like, and how are we poised to close out the week? Do we come back from today's sell-off in the Qs and the S&P 500? And we'll address all of those concerns today. So let's begin with my take is that a lot of people did not get this updated invite. Yeah, we only have 11 people on. Let's say hello to folks. Talon, thank you, sir. Joel, hey, Bob, you nailed the Qs short today. Thank you, sir. I went short at the open. Nice. Good for you, Joel. Good for you. Franklin, welcome, brother. Okay, so let's begin. Let's talk about, hey, Larry, we appreciate how vigilant you are. You're very welcome, Larry. You're very welcome. And thank you guys. I mean, you make everything that I do worthwhile. And that note right there makes my day. So thank you very much. I'm humbled. I'm very much humbled. Let's begin with the economic data on the week, and let's talk about it a little bit because it matters. I'm a firm believer that, one economic report is not going to make or break a market unless a trend is formed. And in this case here, what was setting up was an unsustainable uptrend in the triple Qs. You had leadership names that it was the only place to put your money. Let's face it. What were you going to do? Buy a small cap fund while they're raising interest rates? You're going to buy small caps when the threat of inflation is still rising and the possibility of the Federal Reserve having to kick the can down the road, not once, twice, but now for like the fourth time, you're going to buy small caps? No, the answer is no. So people are going or have been putting their money where they're not afraid of rate hikes or inflation having a very big impact on it. Where did they go? Top 5, 7 names. They have pricing power. They have cash. They don't need to go to the bond market for funding. They have the capital. They're good. Where you wanted to avoid were companies that needed to go to the banks. They needed to go to the bond market to get funding because it was not available. Now these companies are going to have access to this funding at lower rates. And we're going to go over charts tonight of the regional banks, utilities. I mean, everything, real estate. And the other thing that was out there that was getting me these past couple of days is that it was like a resurrection of the CRE, commercial real estate market, was going to implode. It was all over the Twitter sphere. It was just like out of the blue. And, I was posting for months now, another building selling for half of what it was purchased for 5 years ago. We've been talking about this stuff over and over and over again. All of a sudden, it gets all of this attention. And it was just a contrarian indicator that what's old is new now. I don't think so. The probability of the ease in September is growing exponentially. And today, after Jay Powell's 2 days back-to-back conferences over at Congress, today's report was the nail in the coffin. It's done. They're going to go in September, absent some ridiculous CPI or PCE report that comes out, and there will be a couple of them. But those can be manipulated. So we are in a presidential election year. They are going to go in September, conveniently just in front of a presidential election cycle. They're going to go. They're going to do this. So let's get to it. And we'll talk about how we're going to trade this market moving forward. So economic data on the week. Really just skip a lot of this. Initial jobless claims came out today. That was a lower read, a measurably lower read. Nobody really paid attention to that. This is what got the attention. The headline number came in lower. And you're hearing people already talking about deflation. Get out of here, deflation. Prices aren't going down. Show me when prices are going down, then we'll talk about deflation. Where are prices going down? I don't know. Anyway, core CPI. That came in half of what was expected. That was all the markets needed. Going into the day, there was a 67, 70% probability of a cut. Now it's up in the 90s. We'll go to that in a moment. The year-over-year number, again, this really added fuel to the sector rotation files. We had a 3.3% year-over-year read on inflation versus 3.4. Now, a couple of takeaways you got to look at here. One, I spoke about this earlier today, that they do not calculate inflation the way they did back in the 1970s. They used to calculate in the cost of housing. Now they don't. Now they use a survey, owner's equivalent rent. They no longer calculate in coffee. They just took that out. Coffee prices are surging. They just took it out. So is this an honest number relative to the way they used to report back in the 1980s? No. I'll bet you that inflation is probably twice as much relative to the way that they measured it back in the 80s as it is right now. But they need to show a victory. Jay Powell needs to claim victory. He has defeated inflation, even though we're not at the target of 2%. He also needs to defend jobs. And that's what he was talking about yesterday, his dual mandate. He must protect jobs. So what they're going to do is, at the altar of jobs, they are going to sacrifice the consumer. Inflation is going to move back up higher. Maybe not right now, but in the coming months, as sure as God made green little apples, inflation is going back up. In an honest economy, he would have still been raising interest rates the entire time that he's been on ease mode. He has not been honest. Frankly, has he done a nice job for the market? Yes. Has Yellen been spending money hand over fist, providing liquidity? Oh, yeah. Everybody wants to knock how stupid she is as an old lady. She's not. She is a bright woman. So my hat off to her for helping manipulate this market up higher. So what else is coming out? We have tomorrow the PPI index. All right, this can move the markets as well. So beware. This is the measure of inflation. CPI is the measure of inflation at the consumer level. PPI is the level of inflation at the producer level. So they may still see increases at the producer level, but can they pass them on to the consumer? Is the consumer still strong? We know that credit card debt is through the roof and savings they're gone now. And credit card interest rates are sky high. So tomorrow we're going to be able to see through the earnings from JP Morgan, Citi, and Wells Fargo, what's their loan default rate? How are their credit card delinquencies? That's what I'm going to be interested in. So the banks did really, really well today, and they should continue to do very, very well. We own Morgan Stanley, doing very well for us. It's still above par, looking very, very nice. I think it goes higher, absent of a very poor earnings report. So tomorrow, PPI, we got consumer sentiment coming out at 10 a.m. If PPI comes in weak like CPI did today, forget about consumer sentiment. That's not going to act as a blip on the screen. If PPI comes in kind of hot and the consumer is not feeling good, then that consumer report may impact the markets adversely tomorrow. Let's take some comments here. Joel, Bob, would you stay long bonds right now, or are all the cuts coming also old news and therefore bonds move is done? Okay, great question. No, I would stay long of bonds right now. We're going to go to that chart in a moment. The path of least resistance right now in the bond market is to the upside. Are we poised? Are we still at, let me rephrase, are we still in a secular bear market in the bond market? The answer is yes. And what's a secular bear market? That's a bear market that could last 10 to 20 years. So we had a secular bull market, which began in 1982 and ended about 2 years ago. And in the past 2 years, maybe even a little bit longer now, we have been at the beginning of a secular bear market with a lot of time to go before that bear market ends. That, however, is you can get a cyclical bull market within the context of that secular bear market, and that rally could last from 6 months to 2 years. It all depends upon the environment. Now, looking at a couple of things here. I'm going to go to it in a moment, but I'll tease this a little bit. Looking at the yield curve, it has begun to steepen dramatically. I mentioned this last week with members on the week ahead commentary. That's the premium commentary that goes out every Saturday. That we had a breakout on the week. I expected a pullback and a retest of the breakout point this week. We got it. What did the yield curve do today? Steepened yet again. If you're bullish on the equity market, that's the last thing that you want. You do not want to see the steepening of the yield curve. But what does that mean for bonds? Well, it means that bonds are going to move up higher. Why? Because there's fear. People don't want all the exposure to equities. So what they're going to do is they're going to move into bonds. They're going to move into potentially the dollar, and they're going to rotate out of stocks, certain stocks right now. Right now, you have the leadership names, which are giving up their mantle, at least for the time being. And you're seeing sector rotation into banks, transports, small caps, mid caps, utilities. So those names are going to thrive in this current environment until such time as the why behind why we're seeing a steepening yield curve is unveiled. Is it the debt market? Is it ongoing concern issues with several regional banks? Is it a sovereign concern? Japan, China. We had a big Chinese bank that blew up overnight. So we don't know exactly what the problem's going to be that we're going to point to a year, 2 years from now and say, aha, that was why. That was what we were so concerned about. Right now, I'm calling it the everything bubble. There are so many different variables and so many different events that are unfolding right now. We're sending F-16 fighter jets over to Ukraine, and the Ukrainians are targeting with our missiles deep inside Russia. These are acts of war. Is it going to be an event? We have Chinese troops in Belarus. Belarus borders NATO. So we don't know what the pin is going to be. It could be multiple things. We know we had a very poor bond auction. I think it was a 10-year Treasury bond auction. Maybe it was a 30-year. I got to do more research on it, but it did not go well. Shorter duration bond auctions went off without a hitch. Today's, though, I wish I had it up here. Today's, though, did not go off without a hitch. I think it was on zero hedge. Let me spend 30 seconds. I won't spend much time here. Here, China sends record number of warplanes near Taiwan as NATO blasts destabilizing threats. We don't know who's going to be the Democratic presidential nominee. Is it the debt? U.S. spent a record $140 billion in June on debt, 30% of all tax revenues. This is unsustainable. Is it going to be a sovereign issue, a bank issue? Scaramucci gates 70% of investors in his Skybridge crypto fund. That means he's not letting 70% of his clients out. Yeah, here it is. Here it is. Gruesome trailing 30-year auction sees plunge in bid to cover foreign demand. So the 30-year, the longer dated maturities did not go off today very well. And you saw yields on those longer dated bonds move up higher versus the 2-year, versus the 5-year, versus the 10-year. And what that means is that that's the steepening of the yield curve. There's something wrong. We just don't know exactly what it is yet. Could be the debt. I just went over, we scrolled down not even a minute, and we came off with 3-4 different headlines that could tip this market over at any moment. Let's talk about the CME FedWatch tool for September. 92.7. It's been there most of the afternoon. So we have another, they meet on the 18th of September. So we get 2 more CPI reports and PPI reports and PCE reports, maybe just 1 PCE report between now and then. Equity valuation. Now, we've been talking about this, and nothing has changed from today, from where we opened up on Sunday. Despite the fact that the S&P 500 pulled back today, we remain very overvalued. Schiller PE ratio remains with a 36 handle. Earnings better be stellar. They had better be stellar to sport this multiple. And to expect stocks to expand, these companies need to have blowout numbers. I wanted to talk about this for a moment. I thought this was a great post, and this is really a positive. Ever heard of price to earnings growth? You should have heard that. It's Peter Lynch's go-to metric that if a score is below 1, it hints at a bargain, while a greater than 2 might be pricey. Let's see how this applies to the semiconductor space. I think this is pretty good. NVIDIA, and I have another chart here. NVIDIA is on a price to earnings growth basis. Very, very cheap. Netflix as well. Amazon, Meta, Google, ASML. That's a semi manufacturing company. I believe it's the biggest, definitely in Europe, one of the biggest in the world. So these stocks are reasonably priced, especially Nvidia for its growth. So there are going to be opportunities out there. Yeah, here. So Nvidia PE hardly changed in the last 18 months. Think about the price action, right? Gone nothing but up. Yet, here's the price. Forward earnings per share, skyrocket. Forward PE, pretty goddamn steady. It's a steady Eddie. So on any pullback here, you got to be looking at NVIDIA and saying, okay, is this an opportunity? Should I be selling puts here? So on a bullish note, we still have opportunity in these triple Q names. I would just go back to this chart and say, we need to perhaps avoid a few of these. I mean, Microsoft going into the day was very overbought. RSI greater than 80. Tesla was much greater than 80. And I've been saying this, and I'll repeat it over and over again. My worst trade of 2024 was Tesla, yet I made money on it. Think about it. My worst trade of 2024 was Tesla, yet I made money on it. I booked profits too early, and I left a lot of capital on the table, and I kicked myself. Even despite today was down 7%, I still left a lot of money on the table, even if I would have sold today at the close. Okay. So JC Parents put this out this morning. This is before the markets open, and I had to agree with him. His comment, and this is before CPI came out. It's only mega cap tech crowd is going to look pretty stupid if small cap tech stocks break out of this multi-year base to new all-time highs. So we know what happened today, at least on the IWM and the TNA, the broader spectrum of small cap stocks. And he's talking about tech stocks. What I referenced here was more so the wider small cap space, because what we were looking at, and we're going to go to these charts in a moment to see whether or not they still have legs. What I've been looking at is KRE. That's the regional bank ETF. That's been outperforming the XLF. Remember, these names were the doom and gloom sector for the past year and a half. But now they're beginning to ramp up and look pretty darn good, especially in light of a potential decline in interest rates. Also, biotechs. You got to have your biotechs. You need your regional banks for the small caps to move up higher as a whole. JC's referencing the technology portion of that space, but I agree for the most part with his assessment of the small cap arena. Now, I wanted to address this as well. This is put out most of the time. It's good stuff they put out, Game of Trades, but I wanted to take exception with this because I don't think it takes into account. Maybe it does. Maybe it does take into account. Yeah, he is calculating in here a counter trend rally, which is what I was referencing earlier. I should have looked at this more closely, but I think that it's still a valid conversation because what it's doing is validating what I said earlier, is that we're probably going to get a cyclical bull market within the context of a secular bear market in the treasury bond market. So I overlooked this rally here on the chart. So I agree with him on his assessment that we are going to get a rally here. This goes back to the question earlier. Do we believe that the bond market is going to continue to rally? The answer is yes. The more dire this economy looks, the more money is going to rotate into bonds and out of equities. We're not at that point where you're going to get a stampede into bonds yet, but at some point in time you will. But We're not there yet, right? So we just right now it's just sector rotation. We're not running around with chickens. What do you call it? Chicken Little. Running around. The sky is falling. The sky is falling. We're not there yet. We're just prepping the decks and saying, okay, we're seeing sector rotation. We're beginning to see our leadership names fail. This is the way it always works. Leadership names fail, and then you get the dash for trash. Those are your junk stocks. Nobody wanted ARC funds. Nobody. What were they doing last week on a down day in the equity market, along with DRIV, the Autonomous Vehicle Fund? They were up in a down market. What does that tell you? The markets were sending signals last week that today was going to happen. All you needed to do was look. So right now, all we're doing is that we're looking at this market through the lens of sector rotation. That's it. Now, longer term, am I concerned about the steepening yield curve? Absolutely. Absolutely. It is screaming recession is coming down the road. We know that jobless claims are rising. And the scary part is that you have more job openings than you do unemployed. What does that tell you about the state of our education system? We don't have enough educated people to take these jobs on. Yet we pay more per capita, per student than any other country in the world. So today, Nasdaq pukes to the worst day versus small caps in 22 years. Now, I didn't expect that, but we expected this. We expected this sector rotation for quite some time now. Gold, we've been bullish on for quite some time, and we remain long of our gold stocks, gold, etc. No change there. We're not looking to scalp out or scale out and then jump back in on a reaction. No, we're going to hold on there. Okay, so this is from Lance Roberts, and this kind of goes to what I've been saying about rate cuts. People, they believe that the Federal Reserve is going to cut rates, stocks are going to go up. That's not historically what occurs. It's just not what occurs. It's anecdotally, you would think, yeah, that's probably what's going to happen. But remember, the Federal Reserve doesn't want to cut rates. Why? Inflation. However, they're being forced to because the unemployment rate is moving up. They're revising down prior jobs reports. They lied. You can't have this many revisions month after month, year after year now without being an absolute liar. And we've spoken about the two surveys, right? Well, one's not a survey. The establishment report, which is what the media loves to feed us on non-farm payrolls, the second to last Friday of each month, something like that. It's definitely on a Friday. The establishment survey produced by the establishment is just a guess. It's just a guess, and they revise it down. Whereas the household survey, which is where they go out to households and say, anybody not working here? What's the situation in this household? They used to go lockstep. Household survey, establishment survey. Then 2020 came. All of a sudden, the establishment survey went like this after dropping, went like this on recovery, and the household survey went the opposite direction. Somebody was lying. It's not hard to believe that it's the establishment. The people that prepared that report are lying. You can't be this wrong that often. Perhaps in government you can. Anyway, S&P 500 going back to prior rate cuts, 2002. This is actually a little bit, it's actually 2001 when they were cutting rates. Down 41%. That was the dot-com bear market. Financial crisis down 55%. The S&P 500. Nasdaq was down a lot further than that. This is the COVID sell-off. And now we have whatever the heck this is going to be. They're calling it the AI bubble. I don't know about that, but maybe. So historically, folks, when they cut rates, stocks do not go up. They go down because you need not just one rate cut, you need multiple rate cuts for the economy to be able to heal from whatever just impacted our economy surprisingly. Okay. So here is the equity market overlaying the Bloomberg or the S&P 500 overlaid by the Bloomberg Economic Surprise Index. In short, this is in purple is the health of the overall economy crashing, where the S&P 500, which generally trades in tandem with the Economic Surprise Index, has just simply diverged. Now we need to have a reversion to the mean. And two, the yield curve. This is, I believe, posted after the close today. The yield curve is steeping significantly today, confirming a long overdue trend from deeply inverted levels. This is not me. This guy's just repeating what I've been saying for months. This phenomenon has historically been one of the most reliable indicators of an impending recession. The chart below provides an important perspective, suggesting that the steepening move is likely still in its early stages. In short, buckle up. Buckle up. Today was a great day for your small caps. Are we going to fall in love with small caps? No. Will we remain long? Yeah, until the market says no mas. You got to get out. Let's take a look at the weekly charts. Okay. This we did. Now, the weekly charts, remember, folks, we're going to go over, we're going to take a look, because what we're doing right now is we're not preparing for tomorrow. We are beginning to prepare for next week. Right now, we want to get a feel for how is this market behaving on the week, but we also want to keep in mind we have one trading day left to go. So let's talk about it. Bitcoin on the week up 2.71%. An inside bar, no new weekly low or low. Good stuff. Momentum is still declining. So this is just going to do some backing and filling. I'm not a buyer here. I dollar cost in every Monday. So I'll just continue with the dollar cost averaging. But I wouldn't buy aggressively. The CRB commodity index, a measure of inflation. We're holding the rising 20-period moving average. We're consolidating. We're down on the week. That's a good thing for equities. Momentum is declining. We're dropping below the 50 level. One trading day left to go. That could change. Bond yields, critical. Bond yields down 1.85% on the week, but right at support. Do they bottom out here, or do they drop through support levels? That's the big question. Daily view. Absolutely and utterly destroyed today. So what we need to do is we need to get our crayon out and say, okay, what is the path of least resistance? As long as you're trading along the line of least resistance, you're going to do well in this market. If you're going to be in denial that the path of least resistance at current is down for yields and you're going to short stocks for no reason other than they look overbought, then you're kind of mistaken. If you think that this move in the small caps is over, it's not over. Could they pull back tomorrow, the next day? Sure, of course. But they've broken out. We're going to go to that chart in a moment. Let's take a look at the TLT, 20-year bond ETF weekly time frame. Some of these may not have refreshed. I'm just going to refresh them. So we're right at resistance. So again, let's get our crayon out. Where are we at? We're at the apex of a very tight triangle formation. Now, we're trading above the moving averages, the 20 period in red and the 50 period in blue. So the probability of us continuing this rally with higher lows and now higher highs is increasing. Now, I mentioned earlier that we're at the potential precipice of a cyclical bull market within the context of a secular bear market. When do we know that we're in that new cyclical bull market? We need to close out and above the monthly chart above 98.60. That would mark a higher low, and then when it occurs, a higher high. We have broken out of a monthly downtrend. That is not sufficient enough. We do not know whether or not we have enough buyers out there to hammer through all of this resistance above. We do not know that. We need to close above a prior high. Once we do that and we get a continuation move higher, that is your signal. We have a new cyclical bull market in the bull market, in the bond market. I kind of flubbed there. Let's go to a daily view, see how the bond price did. Really good here. I mean, we broke out several days ago. We did a little bit of a consolidation, followed through to the upside. Again, path of least resistance is forming to the upside. If you're thinking about shorting bonds right now, God bless you. Tight stop, please. Tips, Treasury inflation protected securities. So what is this chart telling us? People who buy tips are educated investors. They worry about inflation. That's why they're buying tips. So looking at this chart, the charts tell you a story. They give you the psychology of the institutional investor. What is the psychology of the net buyer of this product? They are scared to death of inflation. How do we know that? Bond tips, I should say, tip prices, Treasury inflation protected securities, bonds, are putting in higher lows and higher highs. This is a bull market. Daily chart. Look at the gap up today. So, wait a minute. The media was using the word deflation today. Deflation, not disinflation, not the slowing of inflation. No, they were using the word deflation. But what did the tip market tell you? It told you, no way we believe in that nonsense. We're going to see inflation. The market doesn't lie. Television announcers do lie constantly. The dollar. So what is the dollar telling us about the rate of inflation? It's down. It's down over a third of a percentage point on the week. It's telling us that it's very, very concerned about inflation. It's also concerned about the yen and the euro. Yen and the euro, the two largest components versus the dollar in the Dixie basket. We're going to go to those charts in a moment. Daily chart. Look at the gap down here today. The dollar was down over a half percentage point. If we had deflation, the dollar should have caught a bid, but it didn't. It pulled back. Why? Because we still have inflation, and they're going to cut rates on top of it. Euro. So we went through the EU elections. That caused some weakness in the euro, several weeks of concern. That's over now. And the euro has regained its footing and is now on track for a major, major breakout here on the euro, which has been in a secular decline for quite a while. This is a very bullish chart. I mean, if you're a guy like me that likes to look for early stage bottoms in whatever currencies, commodities, stocks, doesn't matter to me. This is an early stage recovery play. Let's talk about it for a moment. So we were in a descending wedge formation. I drew these lines months ago. We got the resolution to the upside. Now we pulled back. What was the upper band of resistance has been now the lower band of support for months. So is this a screaming buy? No, but it's certainly worthy of a nibble. Certainly worthy of putting your toe in the water. And if we break to new monthly lows, just stop out. I would not be aggressive. But what is heartwarming, what warms the cockles of my heart, my two favorite indicators are the stochastics and the RSI. Now, I know a lot of people out there, they make fun of me. My charts are very busy. I have a lot going on these charts. These two things I won't take off because they serve to validate what I'm viewing on price and vice versa. So what we have here on the euro, I don't want to make this a show about the euro, but what we have here is a beautiful, beautiful setup. We have a long time before this month is over, so keep that in mind. But take note of this. What this chart is showing us here are lower lows, lower highs, lower lows. RSI, we stopped putting in lower lows back here, whenever the November of 01. Is that accurate? 01? No, that can't be accurate. Is it? No, it can't be accurate. We'll figure it out in a second. So what you have here are higher lows. RSI, the relative strength indicator, is not confirming the downward move. That has been no reason to go buying the euro. But now that we're beginning to firm up here and we're beginning to stop going down, now all of a sudden this becomes important because now we are hooking up. And that bottom was seen. Now I could do that. October of 2022. Think about it. We bottomed out back there. RSI has been nothing but steady Eddie throughout this downtrend. Stokes hooking up monthly time frame. So to me, not a screaming buy, but something that you really want to keep your eye on if you want to preserve your buying power. Suppose you have enough gold. Suppose you have enough silver. You want to diversify out. You want to buy some euro. I'm sorry. This is the yen. I'm sorry, yen. My apologies. I was on the euro. I jumped to the yen. Horse's ass. Okay, I'm bad. Let's go to the monthly chart of the euro this time. Sorry, folks. When you humiliate yourself live, monthly chart, euro. But whatever I said about the monthly chart of the yen holds true. Nothing about that was wrong. I just had the symbol wrong. And people are probably out there going, when's he going to realize that? Okay, so as for the euro, we remain in a bear market, but we're right at that upper band of resistance. Getting ready for a breakout. So maybe it's time. Maybe it's time that we start looking to diversify out of dollars and into euro, into yen, in addition to gold, silver, commodities. Now, going back to the yen, I want to see how it performed on the day. Look at the gap up here today on the yen. Beautiful. Okay, so This chart here worries me quite a bit. Initially, I put a note out to members earlier today that I was probably going to sell my Russell 2000 futures, book a profit, make them real, and then I would sell puts. And that's a bullish bet. And I would just basically get me back in. I would sell them for tomorrow expiration, just below at the money, maybe a 35, 40 delta. And if they're not put to me, heck, I just made a good amount of money on premium alone for doing nothing. But then I took a look at this chart. And I said to myself, self, do you really want to just sell naked puts? Or do you want to hedge that bet a bit? Because the Russell 2000 is so overbought intraday anyway. And relative to the third standard deviation Bollinger Band, we'll go to that chart in a moment on a daily chart. Do you want to hedge that bet by selling a further out of the money call strike just to hedge for protection? Because what we're looking at here on a weekly chart is a breakout on the VIX volatility index. So let's take a look now at the daily chart. And let me go back to that weekly chart for a moment because I didn't do it justice. I didn't articulate just how threatening this is. I want you to take note of this. Here's the S&P 500 weekly time frame. It has done nothing but go straight up. Week after week, higher highs. Week after week after week after week. And it's supposed to trade inversely of the S&P 500. Okay, let's go back to that chart. The VIX, the last lower low that we saw on the VIX was back during the week of May the 20th. Think about it. Nearly 2 months ago, we put in the low on the S&P 500. Again, let me refresh memories here. Week of May the 20th was back here. And we have done nothing but move up higher while the VIX has consolidated. That's a problem. VIX daily chart. So I got to be honest with you. I would have expected a bigger move on the VIX index than what we got today. We were only up a half percentage point. Yes, we broke out, we gapped up, all that stuff. But it wasn't a ruthless rally that we've seen in the past on the volatility index. So the VIX futures contracts, they moved up measurably, but not so the VIX index. And I think it's simply because we have just so much overhead supply above, and that we had some selling in there, keeping a lid on this index. But I think that this could easily break out in the coming, if not days, in the next couple of weeks. Dow Transports. Now, this is more of a bullish story here. It's a bullish story because we broke support this past week. Excuse me, this week, intra-week. And what are we doing right now? Where are we closed? At this snapshot in time, we have a bullish key reversal on our hands. One of my top 5 favorite candlestick patterns, linked below. It's free. Very, very bullish. 1 trading day left to go. So this only adds to what I believe to be a sector rotation story until it stops being a sector rotation story and it becomes an economic problem. And all stocks, including gold stocks, everything's going to go down. But that's going to be an opportunity as long as you have the cash. Daily chart. Look at this move higher today. Over 2% move. Think about it. The S&P 500 was down over 0.75%, with the Dow transports dramatically outperforming the S&P 500. This just goes to show you all those stocks that were leading this market up higher, Microsoft, Google, Tesla, recently anyway, Amazon, all these stocks, Nvidia, they took a break today. And still, just by virtue of their waiting on the S&P 500, you still were able to get a 2% move, a greater than 2% move out of the Dow Transportation Index. Amazing. The Dow Jones weekly chart, still up over a percentage point. How do we do on the day? Up on the day. And we broke out yesterday. Now, what we want to see here is a pullback and a retest of this breakout point. We want to see the same thing for the Russell 2000 as well. Now, the S&P 500 it's a different animal. You have too many stocks that make up the overall weighting of the S&P 500, and it closed down over 0.75%. And look at how extended we are here. If we rally tomorrow, I will be shorting the S&P 500. If they rally the Qs tomorrow, I will add to my short of the triple Qs. So right now, in this snapshot in time, Thursday night, one trading day left to go, we have an outside reversal bar, aka a bullish engulfing of last week's price action, or yesterday's price action. Extremely bad price action. And that's another one of my top 5 favorite candlestick patterns. Link below, 5-part video tutorial. Take advantage of it if you're new to technical analysis. Trip Qs, weekly chart, bearish key reversal. You guessed it, one of my top 5 favorite candlestick patterns. At current, we are just off the lows of the week. Volume is light on the week. But that just goes to tell you something. We were up all week long, except for today, and look at the volume. There's been no volume here. Daily chart, down 2.19%. This is the ascending wedge I spoke about with members last night. This is the proximate reason as to why we added short to the triple Qs using the SQQQ yesterday. And if they would have driven it up higher today, I would have shorted it more and more and more. But today, it was payday. So they broke support and they kept it down all day long. Initially on the CPI report, they rallied the Qs and then they just sold that strength. They faded it really quick. That's how we knew it was going to be a down day for the Qs. So what may happen here? Don't be the least bit surprised. Tomorrow, we get an up day. Following day, perhaps an up day. And they're going to try to recapture what was prior support will now act as resistance. If they take us back up to that area, I will short more triple Qs aggressively. Yes, earnings are coming up, but remember, this is a market that is priced for perfection. Were it a cheap market or a fairly valued market, I wouldn't short into it, not into earnings. But in this situation, it's worth the risk. Small caps. This is a leverage product. If we get a pullback tomorrow, I'll be buying this. So here's your breakout. And using the TNA, again, leverage product is very volatile. If you don't want the volatility, simply look at IWM. And we have a breakout here. Why did this not save? There we go. We have a breakout. Now we want to see is a retest next week of this now support level, hopefully, assuming that we close above this mark tomorrow. Maybe we don't. Maybe we don't. We don't know. But momentum, RSI, breaking out. Stokes, no breakout here. But I drew these lines I don't know, 2 weeks ago. We saw this setting up, and we had higher lows, no higher highs yet, but it's setting up. Momentum is building. It's like a coiled spring. Add to that, we saw this setting up because there was a Bollinger Band event occurring. Let's talk about that for a moment. A squeeze was occurring. So here, TNA, same chart. Look at the Bollinger Bands in black trading inside of the Keltner channels in gray. Look at how narrow the neck is of this consolidation. We began adding aggressively to the futures. We were dollar cost averaging into a small cap fund because for future reference, 6 months after the first rate cut, small caps tend to outperform the overall market. So we began dollar cost averaging in beginning last month. And looking at this chart, I said, you know what? We have a lot of energy in here that's built up. I think it gets resolved to the upside because we were holding the 21 period EMA and the 5 period or 8 period EMA was rising, acting as a floor. And we were down yesterday and the day before yesterday. And the same day, I saw the regional banks were up. They were looking really good. The biotechs were up, yet the small caps were down. And I was like, you know what? That doesn't make sense. And it looks like the biotechs and the regional banks are going to continue up higher. So we began bull operations on the small caps using the futures, which is speculative, right? Because there's no time decay, but there's an expiration date on those futures. So the Bollinger Band squeeze was resolved today, and I think that there's more fuel in the tank. I'd like to see a retest of support, ideally tomorrow. We'll see how the futures open up this evening. Technology, bearish, key reversal. Semis, still up on the week, but a reversal week, one trading day left to go. Biotechs looking the bomb. Consolidation, breakout, bullish. Staples, weakening up here. No new higher highs, weakening up. Discretionary names. We broke out here. I find this shocking. The consumer's dead, but discretionary names are breaking out. This could be because of Tesla. But today we pulled back, but so did Tesla as well. Emerging markets rallying, bullish. Why? Declining dollar, declining yields. Energy, bullish key reversal bar. Oil, has this updated? Yes, it has. We're down on the week still, but we're threatening a major breakout on oil. So I want you to take a break here for a second and just say, let's put all of this together, what I'm talking about. We now have a 92% probability that the Federal Reserve is going to cut rates in September. We also have an inflation rate above 3%, a full percentage point above where they want to be. But there's another problem. We have jobless claims on the rise. So they're going to cut rates to try to stem that from happening. But the argument I'm going to make here is that they are going to unleash the dogs of inflation on this economy. Need a chart? This is the chart for you. Crude oil. I was talking earlier about the transports having the mother of all consolidations. Crude oil. I mean, once this thing gets going in the wrong direction, which is going to be up, we're going a lot higher. This is a major wedge formation, and we are threatening a breakout of this chart. So imagine 1 month following that first rate cut we've broken out here, and you're looking at CPI for September coming out in October, yet you have $100 barrel of oil. What's that report going to look like then? Now, they're going to want you to look at the core number where they back out food and energy, but that's convenient for the powers that be. They're still going to claim victory and have you ignore oil, ignore food. We don't. You can't ignore it. It's reality. What's going to happen when we're up at $100 a barrel after that first rate cut? And we have an economy that is in nearing recession, and they need to cut rates more to save it? Scary. It's very, very scary. Gus, we own this. That's up today. I don't want to spend much time. Gasoline prices down on the week. That's good. Natural gas prices, not sure what's happening here, but man, they're dropping like a rock yet again. Let's go to gold. We'll do a couple of chart requests. We'll call it a night. All right, gold, weekly view. Look at this breakout. Look at this breakout. So what is gold telling you about inflation? The same thing that the tip market is telling you about inflation. The same thing the dollar market is telling you about inflation. It's going up. What did gold do on the day? Jesus Christ. Up over 1 3/4%. And we're going up higher. Gold mining stocks. We own these. Big breakout today on GDXJ, up nearly 6%. Our palladium position, that's down on the week. What did it do on the day? Up 0.75%. I guess we'll take that. Our leveraged speculative position on gold mining stocks, Nugget, up 10% on the week. And folks, we're going to be holding these. We're going to be adding more. Look at this move today. Holy cow. You don't buy these stocks unless you believe that there's inflation out there, and clearly traders do. Let's take a look at some chart requests from members. I think one of them was UVXY, I want to say. We kind of already did that. Oh, no, it wasn't. All right, so we have Larry. We got a bunch today. Morgan Stanley, UTHR. I don't know what that one is. AMT, Dominic with Gold Money, and Dominic. Oh, no, default user. Somebody didn't put their name in there. Tesla. Let's get to it. Let's do it. MS. Folks, I would take requests tonight, but I'm over on time. So my apologies for not being able to do that. Morgan Stanley, they report, I believe it's tomorrow. Big bank earnings tomorrow. I'd be a buyer right here, assuming that we close out the week above where we're trading at current or above 103.51. We're holding par. Great to see. I think that if we get a pullback next week, I'm going to be adding more. I already own Morgan Stanley. I want to buy more. And I think that we're heading up to around 111, 112 per share in the coming weeks. This is all very bullish for the banks. Daily chart. So we're nearing resistance at 106.31. We can hit there tomorrow. I think you need to see that pullback on Morgan Stanley. But again, earnings are coming out, so you never know what it's going to do. But we're long into earnings, Morgan Stanley. I think ultimately this is going up higher. Bullish. UTHR. United Therapeutics. I don't know this company, so we're going to go to a monthly chart first. I would avoid this one. You have way too much overhead supply here. Granted, it can move up higher, but it's a $323 stock. You're at Fibonacci resistance at 327, and then you have quarterly resistance at 338. This is the value of TrendSpider, folks. Again, 35% discount code below. We're using a monthly chart, but I'm also able, while on this monthly chart, to overlay here quarterly resistance. Volume is looking pretty good. I mean, beautiful chart, but we have way too much overhead supply. I wouldn't short it. I would not initiate. I would still hold it. Maybe scale out a little bit. Weekly chart, because sometimes you're up on these trades and all of a sudden they're too big a part of your portfolio and you got to scale out to balance things out. Again, quarterly resistance above. I think next week we may do a retest of this breakout point at around, let's call it 320, 321. And then they're going to make a run. This is like a diamond jig to a barracuda. They're going to make a run at this resistance level. So I still think there's more fuel left in the tank in here. I just wouldn't initiate a new trade. Too much risk, not enough reward. Daily chart. Bearish key reversal day today. Failed breakout. It's not for me. Not at this juncture anyway. It's had a great run. AMT. American Tower. Woo-ah. All these companies are coming to life. I haven't looked at this one in a long time. This is a buy. So, again, we're on a monthly chart, and in dashed line, solid line is monthly support and resistance here. Dashed line, quarterly resistance. Look at where we've been consolidating against. Yes, VWAP in blue, but also along quarterly support. And today you had resolution. The quarter's not over yet. Still very early in the quarter. But the resolution at current appears to be to the upside. Add to that, what you have here is a higher low. We close above 219.73 per share. You're in a new bull market. Weekly view, you have overhead supply immediately above at around 210 per share. I would not initiate a trade here. I would wait for a pullback down to here. 202.28 is my number. I can't buy this. I mean, it's nosebleed levels. It's very overbought. I would wait for the reaction, the retracement, then buy on that pullback. XAUS. Gold money. I actually own this. Quarterly chart. You're in a descending wedge formation. I want to get excited. I just can't. Maybe the monthly chart. I can't get excited about it yet. No breakout here. Weekly chart. I'd be a buyer here. I want to pay more to be right. If we get a close above $6.11, I'm a buyer of the shares or adding more to the position. Not until then. This had so many rallies and failures. I can't count anymore. So I'm not a buyer yet. Even though it's had a heck of a rally, I'm not a buyer yet. Daily chart, it may break out, maybe not. I would wait for that $6.11 mark. Then I would initiate a position then and there. Let's take a look at comments. Yeah, GoPro, those smaller names should benefit from sector rotation. Disaffected Canadian, NVIDIA sellers, insiders. Biggest pop. Oh, great point. Thank you for reminding me about that. I wanted to go over that. Absolutely correct. Absolutely correct. So we've been talking about, at least on Market Wrap with members, about the advancers versus decliners. Where is it? Nasdaq advanced decline line. Here it is. So let's go to a weekly view. Let's get rid of all this junk. Okay. So who said that? Infintab. What this is a massive, massive breakout on advancers versus decliners. It just goes to show you, think about it. The Qs were down 2% more today, yet the advanced decline line ripped through the ceiling. Sector rotation, folks. It's sector rotation. Great point. Thank you for reminding me about that. Franklin, have a great night, pal. Talk to you in the morning. All right, folks. Thank you for being here. I got to cut it short tonight. I have a conflict that I need to get to. Everybody have an awesome night. Don't forget 5-part video tutorial, my top 5 favorite candlestick patterns. Don't forget about TrendSpider, automated technical analysis, 35% discount code below. Like, subscribe, you know the deal. Thanks for being here. Have a profitable trading day tomorrow and a great weekend.